Hey, Austin McKnight, the branch manager here at the McKnight team at Primary Residential Mortgage. And this particular video is going over how we structure the one-time close loans and the benefits and the different programs there are for one-time close loans. There's a lot to dive into here as the one-time close are structured a little uniquely, especially with not having interest-only payments during construction. And so we're excited to share this information with you and how they're structured. As we mentioned in the general overview, which hopefully you had a chance to watch, the regular normal process is called a two close loan. And that means you have a separate construction loan from your permanent loan. You're going to qualify twice and you're going to close on those loans twice. With the construction loan, you're going to have a percentage down up front. A lot of times across the country, it can vary, but the standard is 20% down. On that loan, you're going to have construction closing cost, right? Just like you would have with any other loan. During the construction phase or loan, you're going to have interest only payments that are increasing during that construction loan process. As your builder is taking draws, your loan amount is increasing, and so are your interest only payments during that time. And then we get to the end of construction and you're going to refinance that loan into your permanent mortgage where you're making principal and interest payments. With that two close setup, you have the permanent loan refinance has closing costs as well. Probably one of the biggest misconceptions around one-time close is that it has less closing costs because there's not two closings. As we mentioned earlier, the construction to perm loan or single close construction loan still has two phases, a construction phase and a permanent phase. Although you're only closing one time up front, it still has two sets of closing costs and we still have construction interest. How we structure those costs, though, are what is different with this particular one-time close. So let's talk about those three costs. So like I mentioned, we have construction financing costs. Those are like your construction loan closing costs. These costs are really covering the administration piece, the construction administration piece of construction. We use national capital funding for our draws and in construction administration piece. They work directly with your builder and they will gather in everything that's needed, the inspections, the title updates, and all the pieces of the puzzle that is needed to get your builder his funds as he's going through the process. The second set of cost is the construction interest. As we talked about, a normal construction loan, you're making interest only payments during construction, and we still have that same cost here. There is money being lended out, and for an investor to lend out money, there is interest accruing on that money. The third cost is that permanent loan or permanent phase closing cost. And this would be true if you were to refinance a loan or if you go purchase an existing house, you're going to have closing costs. And these are lender closing costs, they're title charges, your escrow and prepaids and reserves, putting your escrow account together. These are your standard closing costs that you would see on pretty much any normal mortgage. Now, with the one-time close, like I said, we still have all these same costs. The difference is we actually work with your builder to build these costs into the price of the home. So we're take what we call the builder's base home sales price, what the builder wants to build the home for. We roll in the construction financing cost, the construction interest, and the permanent loan closing cost to get a final contract price. Now, you may say, well, how can we roll all these things in? A typical builder that builds what we call spec homes or speculative homes, this means they go to the bank themselves, they get a loan out, and they start building a house. They don't have a customer yet. They're hoping to have a customer by the end of construction. They are building in these costs anyway. They're going to a bank. They have closing costs on the construction loan that they're getting as a builder. They're making interest-only payments during construction. They're already building these costs into the home loan or the home price, sorry. And so with that, these costs, the construction financing costs and the construction interest are in any new construction home you buy. If it's from the big tract built homes down to the small custom builder, somebody is paying for these costs. And it's either built into the price of your home, or you're going a to close route and you're paying these fees out of pocket. And again, with PRMI's one-time close, we're working with you and the builder to structure these into the price of the home. We also include those contributions to closing costs and prepaids. Why? So then therefore, you can just come out of pocket for whichever loan program you decide to go with, the minimum down payment. This almost eliminates any money in cash to close needed in most cases, because you're just having to come out with the 3.5% if it's FHA, or VA and USDA are 100% financing. So let's take a little example and see, what does this look like? So in this scenario, we're starting with a $350,000 base home sales price from the builder. That's what the builder wants to take home at the end of the day for building you this product. We put some numbers together, and between the construction financing cost, the construction interest, and having the builder pay your closing cost, you're looking at, let's say, adding in about $40,000. So my contract with that builder now is going to be $390,000. Now I also have a land contract to purchase the land for $100,000. And in the world of construction financing, we have something called an acquisition cost. There's more on this if you actually own your land, and how the land equity is credited and all of that in my land equity video. So if you own your land, make sure to check that video out. In this scenario, though, we're going to be purchasing the land for $100,000. This makes our total acquisition cost, which is the construction contract price plus my land contract price, $490,000. So if you're looking to go the FHA route, that's a minimum 3.5% down, then you would be bringing 3.5% down of the $490,000. If you're going the VA or USDA route, those are 100% financing options, and therefore we would lend the full $490,000. Now, as I just mentioned, some of the loan to values that you can go to with FHA, VA, and USDA, I also wanted to provide some other benefits or differences between some of the other products. As we mentioned, VA and USDA, we can lend up to 100% of the lower of cost or appraised value. With FHA, we can lend up to 96.5%. That's where the 3.5% comes in that you're having to put down, because we can't lend the full 100% with FHA. With all three products, we go down to a 620 credit score per our guidelines. Having said that, with FHA and VA, there are at times some exceptions we can make depending on other factors and compensating factors in your file, where it may allow us to go a little bit lower than that. And we're happy to work with you to try to get your score up to that 620 mark as well. As far as loan limits, VA, we go up to about a $1.5 million loan limit. Sometimes, again, depending on the strength of the file, we may be able to get an exception higher than that. But our guidelines printed maximum is 1.5 million. With FHA, we have county loan limits, and FHA sets these limits per county across the country. You can literally Google FHA county loan limits, and you can type in your county and pull up those limits. And it does differ per, if it's single family, 2 unit, 3 unit, or 4 unit, what the maximum is for that county. With USDA, we don't really have loan limits with the guaranteed USDA product, but it's going to be self-limiting from a debt to income standpoint. And there is a household income limit with USDA that does change per MSA and area that you live in and county that you live in, what your household income can be for that product. So it's somewhat self-limiting with the lower debt to income ratios and the household income limit. As far as speaking of max debt to income ratios, VA is unique. They don't really use a debt to income ratio, although it's looked at as just another factor in considering the mortgage. We actually use what's called a residual income method, and it's kind of based on how many people you have in the household, the size of the house, what your residual income is left over and what area of the country you're in. So we'll take your income, your gross monthly income, deduct property taxes, or I'm sorry, federal taxes, Social Security, Medicare, all of those things. We'll deduct your monthly liabilities out of that. We take in a factor for maintenance costs and things. And then VA says you need to have X amount of residual income left over. But this can actually be of great benefit to go much higher. You can get qualified for much higher than normal debt to income programs like FHA, USDA, or conventional with a VA loan and those VA benefits. FHA, you're typically limited to a 57% back end ratio. There are other factors that may limit that further, depending on manual underwrites or automated underwrites. But typically, the maximum we're going to see, even with the best of files, is 57%. USDA, the normal max debt to income ratio is 41%. Again, maybe some exceptions based on quality of file, credit score, and other factors of the file, but for the most part is 41%. It's much lower than even a conventional loan in that standpoint. As far as mortgage insurance, there's no monthly mortgage insurance or anything with VA. They do have an upfront funding fee that is waived for any veterans that are have a disability rating. With FHA, there's an upfront mortgage insurance premium of 1.75% and then a small monthly premium, and it depends a little bit on your loan to value and how much you're lending. Same with USDA. There's a upfront fee that they roll into the loan, and then there's also a small monthly fee that is included in the monthly payments. I hope you found this helpful in comparing the different products, looking at a breakdown and how we structure that construction contract and rolling those costs in, and the reason why we have no payments during construction, having the builder be responsible for that construction interest. If you have other questions, please don't forget to watch the other videos that we have in this 4-part series. But as you have questions, please feel free to schedule a call with us. We're happy to help any way we can, and we're excited to help you build your dream home. Thank you.